September 15th, 2008. If you were anywhere near the world of finance, you remember that day. You remember the feeling in the air.
Oh, absolutely. It was electric in the worst possible way. The day the world seemed to just stop.
And if you were a homeowner, you probably remember that sudden knot in your stomach. Even if you didn't know what Lehman Brothers was, you felt it.
You felt the shockwave. And if you were just watching the news, you saw the ticker on the screen, just falling. A waterfall of red.
We are, of course, talking about the bankruptcy of Lehman Brothers, the largest bankruptcy filing in United States history. And I think we need to start with the sheer scale of it, because the numbers, over time, they just become abstract statistics.
They do, but they are just staggering. When they filed for Chapter 11 that Monday morning, they cited bank debt of $613 billion.
$613 billion?
And another $155 billion in bond debt. The asset side of the ledger was nominally $639 billion.
To put that in perspective for you, that balance sheet, Lehman's balance sheet, was larger than the entire gross domestic product of a country like Switzerland.
Right. This wasn't a regional bank going under. This was a financial institution that was, for all intents and purposes, a sovereign state of capital. And it collapsed. It collapsed in a single weekend.
The immediate impact was like a global cardiac arrest. The Dow Jones dropped over 500 points that day.
Which at the time was the largest single-day drop since the aftermath of 9/11.
Exactly. The commercial paper market, which is the lifeblood of corporate short-term funding, it just froze solid. Money market funds broke the buck. It was the trigger.
It was the trigger for the Great Recession.
Yeah.
No question. And that's really the mission for this deep dive. We're not just here to do a postmortem on numbers.
Right.
We have a mountain of sources here. I mean,
Yeah.
We've got the monster, the 2,200-page report by the court-appointed bankruptcy examiner, Anton Valukin.
Which is basically the autopsy report of the century for a financial firm.
It really is. We also have biographical histories of the Lehman family, internal emails that were released during all the litigation that followed.
And what we're trying to figure out is the arc. It's the story. How does a company that starts before the American Civil War,
A firm that survives the Great Depression,
2 world wars, the hostile takeovers of the 80s, even having their headquarters basically destroyed on 9/11, how does that firm, with that history of survival, just evaporate in 48 hours?
It's the ultimate story of evolution. And I think, the ultimate story of hubris. It's like a Greek tragedy, but with spreadsheets and derivatives.
A Greek tragedy with spreadsheets? I like that.
You have this company that had this incredible DNA for pivoting, for moving to where the money was, until finally they pivoted into a corner they just couldn't get out of.
So let's unpack that. Let's start at the beginning, because I think most people, when they hear Lehman Brothers, they just picture Dick Fuld, the guys in suits carrying the cardboard boxes out of the skyscraper in 2008.
Right, the end of the story.
But the DNA of this company was forged way back. We're talking 1844.
Yeah, it's a classic American business saga. It starts with an immigrant story. A man named Lehman, who is the son of a cattle merchant in Bavaria. He comes to the United States in 1844.
And he changes his name, right?
He does. He becomes Henry Lehman.
Yeah.
And he settles in Montgomery, Alabama.
Which is such an interesting detail in itself. The roots of this quintessential Wall Street giant are actually in the Deep South, in the Cotton Belt.
Exactly.
Yeah.
And he opens a simple dry goods store, a general store called H. Lehman. A few years later, his brothers, Emanuel and Mayer, they arrived from Germany, and in 1850 they renamed the business Lehman Brothers.
And what are they selling at this point? Just shovels, seeds, fabric?
Basic necessities.
Yeah.
General merchandise.
Right.
But this is where we see the first major pivot, the first flash of that Lehman DNA we were talking about. You have to picture the mid-19th century South.
Right.
The economy is a monoculture. It's all about one thing. Cotton is king. And the brothers, they realize that the local farmers, they don't always have cash on hand to pay for their goods. But what they do have is cotton.
So they start bartering. They take cotton in exchange for tools.
Essentially, yes. They start accepting raw cotton as payment. And it doesn't take them long to have a fundamental realization, one that just changes the family's destiny forever.
What's that?
Trading the cotton itself is way more profitable than selling the dry goods.
So the real money wasn't in the shovel, it was in the commodity the shovel was being used to produce.
Precisely. So they pivot. They become cotton brokers, cotton traders. But, and we have to be really clear about this because the historical record is unambiguous. You can't talk about the cotton trade in Alabama in the 1850s without talking about the system that produced it.
Right, and that system was built entirely on slavery.
Explicitly. The pre-Civil War economy in Alabama depended almost entirely on the forced labor of enslaved people. I mean, the sources note that in the 1860 census, enslaved individuals made up nearly 45% of Alabama's total population.
And the firm wasn't just, adjacent to the system, they were participants.
Direct participants. The 1860 census specifically lists Mayer Lehman as the owner of 7 enslaved people, 3 males and 4 females.
So the initial capital, the seed money that eventually grows into this Wall Street behemoth, it was directly derived from a trade that was the product of enslaved labor.
That is the historical fact. It's a very dark part of the foundation of the firm, but it's the reality of how a lot of capital was accumulated in America in that era.
Then, of course, the Civil War comes, that system is destroyed, the economy of the South is just decimated.
And for a lot of businesses based in the South, that was it. Game over. But Lehman, they pivot again.
They saw it coming.
It seems so. It shows their foresight. Even before the war started, back in 1858, they realized that the center of gravity for cotton trading, for the financing side of it, was shifting north.
To New York City.
Right. So they opened an office at 119 Liberty Street in Manhattan. Emanuel, one of the brothers, moved up there to run it.
They were becoming a New York firm before the war even began.
Which is what saved them. After the war, with the South in ruins, they doubled down on New York and they really leaned into institution building.
What do you mean by that?
They helped found the New York Cotton Exchange in 1870. This was a massive deal. It was an innovation that standardized the crop. It turned cotton from just a physical pile of fluff into a tradable, liquid financial instrument.
This feels like the moment they stop being merchants and start becoming, for lack of a better word, finance guys.
That's it, exactly.
Yeah.
They joined the New York Stock Exchange in 1887, and then, at the turn of the century, around 1906, under the leadership of Philip Lehman, they make the next huge pivot.
Away from commodities.
Away from just commodities and into what we now think of as investment banking, underwriting stock issuances for companies that want to go public.
And when you look at the list of companies they took public, it's basically a history of 20th century American consumerism.
It really is. They partnered up with Goldman Sachs on a lot of these deals.
Which is so ironic considering how Goldman became their mortal enemy and, ultimately survived them.
Deeply ironic. Together, they brought huge names to the market. General Cigar Company, Sears, Roebuck & Company. They underwrote the offerings for F.W. Woolworth, for Macy's, Gimber Brothers. They were financing the birth of the American department store.
Okay, but then comes the big test. 1929, the Great Depression. This is the graveyard of banks. How does a firm like Lehman that's so tied to the stock market survive when the market literally ceases to function?
This is where Robert Bobby Lehman comes into the story. He's the grandson of one of the founders, and he takes over in 1925, just before the crash.
So he's a young man when this tidal wave hits.
He is. And when the crash happens, the equity market is dead. Stone dead. Nobody is issuing new stock. Nobody's buying bonds for retail companies. So Bobby does what Lehmans do. He pivots.
He pivots again. To what?
He shifts the firm's focus to what we would now call venture capital.
Venture capital in the 1930s. I didn't even think that term existed yet.
The term didn't, but the practice did.
Yeah.
He realized they need to invest in the next thing, so they started backing these high-risk, high-reward emerging industries.
Like what?
They backed a company called Dumont Laboratories, which was the first commercial television manufacturer. They funded RCA. They moved heavily into the oil and gas industry, financing companies like Halliburton and Kerr-McGee.
So while everyone else is stuffing cash under their mattress, Lehman is betting on the future of television and oil?
They bet on the future because the present looked so bleak. And it worked. They not only survived the Depression, they came out of it stronger. But as we get into the post-war era, into the 60s, the family part of the story starts to fade.
Right. Bobby Lehman, he ran the firm for 44 years. He was an absolute titan. But when he died in 1969, there was no other Lehman family member left to take over.
And that's always the most dangerous moment for family dynasty, isn't it? The end of the bloodline at the top.
It created a massive power vacuum. And it happened to coincide with the 1970s, which, if you look at economic history, was just a brutal decade for finance.
Oh, it was awful. Stagflation, oil shocks, volatile markets. By 1973, Lehman Brothers was actually on the brink of failure again.
And this is when the outsider comes in, Pete Peterson.
Right. Pete Peterson is brought in from a company called Bell & Howell. He was not a Lehman guy. He wasn't a Wall Street lifer. He was a manager, a fix-it man.
And he did it. He fixed it.
To his credit, he absolutely did. He slashed costs, he acquired another firm called Abraham and Company, and he engineered a huge merger with Kuhn Loewenkamp, another prestigious firm. Under Peterson's leadership, Lehman had 5 straight years of record profits.
But profits don't always create a happy family. And this leads us to what some people call the Civil War era at Lehman. And I find this part fascinating because it really sets the cultural stage for the firm that Dick Fuld would later inherit.
It absolutely does. To understand what happened, you have to understand the 2 warring tribes inside any investment bank.
Okay.
On one side, you've got the investment bankers. These are the deal makers. The relationship guys, they wear the nice suits, they have the long lunches, they shake hands with CEOs. Pete Peterson was the king of the bankers.
And on the other side?
You have the traders, the guys on the trading floor. They live and die by the second-to-second ticks of the market. They're lighter, they're rougher, and they tend to see the bankers as, empty suits who just talk a lot.
And at Lehman in the late 70s and early 80s, the traders were starting to make all the money.
That's the key. The market volatility meant that trading profits were exploding. And the head of the traders was a man named Louis Glucksman. He was a rough-edged, chain-smoking, incredibly intense guy.
And he's looking at Peterson.
He's looking at Peterson, the smooth banker, running the show, and he's basically saying, my guys are generating the profits. Why are you in charge?
So we get a coup.
A literal boardroom coup. In 1983, Glucksman skillfully maneuvers to oust Peterson. Peterson is pushed out. Glucksman takes sole control of the firm. It was a complete victory for the traders.
But a short-lived one.
A Pyrrhic victory. It turns out that winning the war destroyed the country. The internal environment just became toxic.
I read that Stephen Schwartzman, who was there at the time, before he went off to found Blackstone, he described it as dysfunctional and extremely competitive.
That's putting it mildly. The partners started warring with each other instead of competing with other firms. The place just fell apart. Within a year of the coup, in 1984, the firm was in so much turmoil they were forced to sell themselves just to stabilize the ship.
And they sold to American Express, which to me always seemed like such a bizarre cultural fit. You have this very staid corporate, do-you-know-me credit card company trying to manage a pack of, Wall Street wolves like the Lehman traders.
It was a disaster, a total culture clash. It lasted for 10 years, but by all accounts, it was a miserable marriage for the entire decade.
So in 1994, Amex finally throws in the towel.
They had had enough. They decided to spin off the investment banking division. And so, Lehman Brothers Holdings, Inc., goes public. It's an independent company once again.
And this is the moment. This is when the final major character in our tragedy steps onto the stage. The man who would become completely synonymous with Lehman Brothers.
Richard Fuld.
Dick Fuld. The gorilla.
That's what they called him. He was the trader by background. He came up on the commercial paper desk. He was intense, famously intimidating, and just pathologically competitive. He takes over as CEO of the newly independent firm in '94.
And his whole mission, his driving force was validation, wasn't it? He wanted to prove that Lehman wasn't just some reject, some cast-off from American Express.
Oh, he had a massive chip on his shoulder. He wanted Lehman to be a bulge bracket firm, tier 1, right up there with Goldman Sachs and Morgan Stanley. He was obsessed with it.
And for a long time, he was wildly successful.
Incredibly successful. He guided the firm through the Asian financial crisis in 1997. He steered them through the collapse of the hedge fund long-term capital management in 1998, which took down a lot of others. He seemed to have the golden touch.
And then came September 11th, 2001. And I think we really need to spend a moment here because the psychological impact of 9/11 on the firm and on Fuld was just profound.
It was. You have to remember, Lehman Brothers had offices in the World Trade Center. They occupied 3 floors of the North Tower, 1 WTC.
And they lost an employee in the attacks.
Tragically, yes. 1 employee was killed. But their global headquarters was right across the street at 3 World Financial Center. It wasn't hit by a plane, but it was so severely damaged by the collapse of the towers that it was rendered completely unusable.
So in an instant, you have a global investment bank, a firm managing hundreds of billions of dollars, and they have no office. They are effectively homeless.
6,500 employees were displaced in a moment. But the story of their recovery is it's the stuff of Wall Street legend. And this is where that Lehman culture of toughness really hardened into something else.
They just scattered, right?
They did. They moved their entire trading operation to backup facilities in Jersey City. But the investment banking division, the deal makers, they literally took over the Sheraton Manhattan Hotel in Midtown.
I love this detail. They were running a multi-billion-dollar banking operation out of a hotel.
Out of a hotel. They converted the lounges, the ballrooms, and all 665 guest rooms into offices. They were ripping out beds and putting in desks and trading turrets. They were running fiber optic cables down the laundry chutes.
That's just incredible. Imagine trying to close a billion-dollar M&A deal while sitting on a hotel chair in a room that still smells faintly of room service.
It is the definition of resilience. And here's the thing. Within 48 hours of the stock market's reopening, they were fully operational.
And Fuld didn't even wait for their old headquarters to be repaired.
No. He made a statement. He immediately went out and bought a brand new 32-story skyscraper at 745 7th Avenue from their rival, Morgan Stanley. Paid $700 million for it and had the entire firm moved in by January 2002.
But there's a real double-edged sword to that kind of experience, isn't there? Surviving something so traumatic, being literally bombed out of your building and being back in business within a week. That has to change your mindset.
It does. Many people, including Valukas in that examiner's report, point directly to this moment. It created this powerful, almost dangerous sense of invincibility.
A feeling that if we can survive this, we can survive anything.
Exactly. It forged this intense us-against-the-world mentality. It bound the employees to fold and to each other. But it also, very likely, blinded them to future risks. They felt bulletproof.
And that feeling of being bulletproof, that confidence, combined with what was happening in the broader economy, that led them straight into the arms of the housing market.
Right, into the heart of the storm. You have to connect the dots. After 9/11, the Federal Reserve under Alan Greenspan slashed interest rates to historic lows to keep the economy from grinding to a halt.
Money became cheap. Very cheap.
And when money is cheap, big investors, pension funds, they go hunting for yield. They need to find better returns than they can get from safe government bonds.
And the best returns, the highest yields, were in real estate.
Bingo. Which brings us to part 4, the house of cards. The mortgage obsession. Starting around 2003 and then just accelerating wildly through 2006, Lehman made a conscious, strategic decision. They didn't just want to trade mortgage bonds anymore. They wanted to own the entire supply chain.
Vertical integration. They wanted to be the ones making the loans, packaging the loans into securities, and then selling those securities.
And to do that, they went on a buying spree. They acquired a company called Aurora Loan Services, which was what's known as an Alt-A lender.
Okay, let's break that down. Alt-A. What does that actually mean?
It's a kind of mortgage that sits between prime and subprime. It basically means the borrower has a decent credit score, but maybe they can't or won't provide full documentation of their income. They were sometimes called liar loans.
Not a great sign. And they also bought BNC Mortgage,
which was pure, unadulterated subprime. These were loans to borrowers with poor credit histories, high risk. And by 2006, these two subsidiaries, Aurora and BNC, were originating almost $50 billion in mortgages per month.
$50 billion a month.
Lehman became the #1 underwriter of mortgage-backed securities on Wall Street. They were the king.
Right.
But there was a fatal shift in their strategy.
It wasn't just move the product anymore.
Correct. The old, safer model was called originate to distribute. You make the loan, you package it into a bond, and you sell that bond to a pension fund in Norway or a bank in Germany. You get a fee, but you don't keep the risk.
But Lehman started doing what? Originate to hold.
Exactly. They started keeping huge chunks of these risky mortgage bonds and other real estate assets on their own books. The returns were so juicy they couldn't resist. They were eating their own cooking.
And they were doing this with a terrifying amount of leverage. We hear that word leverage thrown around all the time. Can we just break down exactly what Lehman's position looked like?
We have to. By 2007, early 2008, Lehman had total assets of roughly $680 billion. But their actual capital, their tangible common equity, the cushion they had against losses, was only about $22.5 billion.
So that's a leverage ratio of about 30 to 1.
30 to 1.
Let's use an analogy for that. That's like me buying a $300,000 house, but I only put down $10,000 of my own money.
That is the perfect analogy. And if the value of that house drops by just over 3%, your $10,000 down payment is completely wiped out. You're insolvent.
And in Lehman's case, a mere 3 to 5% decline in the value of their massive real estate portfolio would erase 100% of their capital. The entire firm.
They had no margin for error. None. And they knew the market was getting shaky. Which brings us to one of the most infamous parts of this whole saga.
Repo 105.
Repo 105. This is where the Valukas report really just drops the hammer.
It sounds like a secret weapon from a spy movie. What was it, actually?
Okay, so a normal repo, or repurchase agreement, is a standard boring transaction on Wall Street. It's like a pawn shop for bonds. I give you a bond as collateral, you give me cash overnight. The next day, I buy my bond back for a tiny bit more money. It's a short-term loan.
Okay, that's normal.
That's totally normal. It's just a financing transaction. But Lehman found a loophole. A legal opinion from a law firm in the United Kingdom. They used a UK-based subsidiary because English law, unlike U.S. law, allowed them to classify some of these repo transactions as a true sale rather than a financing.
And why does that distinction, sale versus financing, matter so much?
Because if it's a sale, the assets, the bonds, temporarily come off your balance sheet. If it's just a financing, the assets stay on your balance sheet and you just show more cash and more debt.
So, at the end of every quarter, right before they had to take the public snapshot for their earnings report,
They would use Repo 105 to temporarily move $50 billion of assets off their books.
so for a few days, they looked $50 billion smaller and therefore much less leveraged. Their leverage ratio looked healthier to investors and rating agencies.
Precisely. And then, as soon as the new quarter began, they'd reverse the transaction and the assets would pop right back onto the balance sheet.
Yeah.
It was accounting gimmickry. It was cosmetic surgery for the balance sheet.
And the examiner's report called it materially misleading.
It did. And it noted that the top executives, including Fuld and the CFOs, they all signed off on the financial statements that were based on this gimmick.
So we get to 2008, the slow-motion crash starts to unfold.
Well, the first big warning shot had already been fired. Bear Stearns collapses in March of 2008. Now, this is a crucial point. The Federal Reserve and the Treasury Department stepped in. They brokered a sale of Bear Stearns to J.P. Morgan, and importantly, they guaranteed $30 billion of Bear's toxic assets.
So the lesson the market learned was the government has our back.
The too-big-to-fail doctrine was born, or at least confirmed. The market assumed that if another big firm like Lehman got into similar trouble, the government would do the same thing. It created a huge moral hazard.
But Hank Paulson, the Treasury Secretary, he got a lot of political heat for that Bear Stearns bailout.
A ton of it. He was being accused of bailing out his Wall Street buddies. And he did not want to do it again.
So Lehman posts this surprise profit in the first quarter of 2008, which was a total head fake. But by June, reality bites.
They announced their first quarterly loss since being spun off from Amex, a loss of $2.8 billion. The stock, which had been in the 60s and 70s, just starts to crater.
And Fuld starts cleaning house.
He does. He fires his longtime COO, Joe Gregory. He pushes out CFO, Aaron Callan. But he refuses to sell the company at a low price. He's still holding out. He thinks he can find a partner, an investor, not a buyer.
He didn't want to sell the firm. He just wanted a capital injection.
Right. He talked to everybody. Famously, he talked to Warren Buffett. Buffett took one look at their books, saw how complex and opaque their derivative positions were, and just walked away. But the big hope, the real white knight, was the Korea Development Bank.
I remember this. All through August of 2008, the rumor on Wall Street was the Koreans are coming to save Lehman.
It was the last lifeline. But in early September, the talks completely fell apart. The KDB got cold feet. Some reports say the price was too high. Others say the Korean regulators just looked at Lehman's toxic real estate portfolio and got terrified.
And when that news broke?
When the news broke on September 9th that the KDB deal was dead, Lehman's stock plunged 45% in one day.
And this leads us to an anecdote that I think just perfectly, painfully encapsulates the culture of denial inside the firm's leadership at that moment.
The Neuberger-Berman email.
Yes.
Oh, this is just... it's breathtaking. So Neuberger-Berman was the asset management division of Lehman. It was the stable, profitable, safe part of the business.
They managed money for wealthy clients.
Right. It was separate from the high-risk trading floor. As the stock is in free fall, a group of senior executives at Neuberger sends an email to Lehman's executive committee.
And what did they suggest?
A very sensible thing. They suggested that the top management at Lehman Fuld and his lieutenants should publicly announce that they were foregoing their multi-million-dollar bonuses for the year.
A gesture of accountability. A way to signal to the market, we get it, we're sharing the pain.
A simple, powerful PR move. But one of Lehman's directors, George Herbert Walker V, a cousin of President Bush, he got wind of this email, and he was horrified.
Horrified by the suggestion.
He dismissed it completely. He actually sent an apology to the executive committee for the email even being sent. He wrote, and this is a direct quote, "Sorry, team. I am not sure what's in the water at Neuberger-Berman. I'm embarrassed, and I apologize."
Wow. The house is on fire. The stock has been vaporized. And the leadership is embarrassed by the suggestion that they shouldn't take their bonuses.
It just shows the complete disconnect from reality, the sense of entitlement. They truly believed they had earned those rewards, regardless of the outcome for the firm or its shareholders. But the market didn't care.
And so we arrive at the final weekend, September 12th, 13th, and 14th, 2008, the death watch.
Timothy Geithner, who was the president of the New York Fed at the time, he summons the CEOs of all the major Wall Street banks to the Fed's fortress-like building in Lower Manhattan.
He basically locks them in a room for the weekend.
He does. Jamie Dimon from J.P. Morgan, John Thain from Merrill Lynch, Lloyd Blankfein from Goldman Sachs, they're all there. And the message from Geithner and from Hank Paulson is crystal clear.
There's no government money this time.
Paulson was adamant. He said, "I cannot be Mr. Bailout again." He told the assembled CEOs, "You guys, the private sector, need to come up with a solution. You need to fund a rescue, or the whole system is coming down on Monday morning."
So who are the potential buyers for Lehman at this point?
It really came down to just two: Bank of America and the British bank, Barclays.
And Bank of America, they took a look under the hood and ran screaming.
Pretty much. Ken Lewis, the CEO of Bank of America, realized that another firm, Merrill Lynch, was also on the ropes. And Merrill had a much better, cleaner business with its massive brokerage army. So in a stunning twist that weekend, Bank of America just pivots and buys Merrill Lynch instead.
Which left only one potential savior.
Barclays. And Barclays wanted to do the deal. Bob Diamond, the head of Barclays Capital, saw it as a once-in-a-lifetime opportunity to buy a premier U.S. investment bank on the cheap.
They had their teams working all weekend. They had a structure ready to go.
They were ready. The lawyers were literally drafting the press releases announcing the deal on Sunday morning. But they overlooked one crucial hurdle.
The British regulator.
The British regulators, the Financial Services Authority, the FSA.
And they were not on board.
Not at all. The head of the FSA, Hector Saints, basically said, "We're not going to waive our rules that require shareholder approval for a deal this large." And then famously, the British Chancellor of the Exchequer, Alistair Darling, got on the phone with the Americans and delivered the fatal line.
What did he say?
He said, "I am not going to import your cancer."
Brutal. I am not going to import your cancer.
That was it. That was the death knell. When that message was relayed to the room at the New York Fed on Sunday afternoon, everyone knew it was over. There was no buyer. There was no government bailout. Lehman was a dead man walking.
What happened in those final hours?
The regulators, the Fed, and the SEC, they told Lehman's lawyers, "You have to file for bankruptcy before the Asian markets open on Monday." They were trying to contain the explosion.
That Sunday must have just been absolute chaos.
There was a moment of pure pandemonium. The International Swaps and Derivatives Association, ISDA, they held an emergency, unprecedented trading session on a Sunday afternoon.
On a Sunday?
Yes. To allow banks to try and net out their derivatives exposures to Lehman. They were frantically trying to untangle as many wires as they could before the bomb went off.
And then, shortly before 1 in the morning on Monday, September 15th.
Lehman Brothers Holdings, Inc., filed for Chapter 11 bankruptcy protection.
I still remember the images from that next morning. It wasn't just the stock chart going to zero. It was the people, the employees, just streaming out of that big glass building in Times Square, holding those little cardboard boxes with their desk plants and their family photos.
The end of an era. 158 years of history, from the cotton fields of Alabama to the pinnacle of global finance, all of it gone with the stroke of a pen on a legal document.
But the firm didn't just vanish into thin air. The corpse had to be carved up. And this is the part of the story, the liquidation, which sounds dry, but the details are actually wild.
It was a fire sale of historic proportions. Everything must go. Barclays, the bank that was blocked from buying the whole firm on Sunday.
They came back on Tuesday. And
because Lehman was now in bankruptcy protection, Barclays could do what's called a cherry-picking deal. They could buy just the good parts.
The clean part.
The North American investment banking and trading divisions, they didn't have to take on any of the toxic real estate or the legacy debts.
They picked the raisins out of the cake, and what did they pay?
They paid $1.75 billion. And get this, that price included the brand new headquarters building at 745 7th Avenue, the one Fuld bought for almost $1 billion by itself, and 2 state-of-the-art data centers in New Jersey.
That is an unbelievable bargain.
It was the steal of the century. The bankruptcy judge, James Peck, he basically had to approve it. He said, "I have to approve this transaction because it is the only available transaction." Lehman Brothers became a victim, in effect, of a tsunami.
And what about the international pieces, the operations in Europe and Asia?
The Japanese bank, Nomura, swooped in. They bought the Asian franchise for about $225 million. But the European deal is the one that just blows my mind every time I read about it.
What happened there?
Nomura acquired Lehman's European investment banking and equities divisions. They took on 2,500 employees. Do you any guess what they paid for the business itself?
I'm afraid to ask.
$2.
You're kidding me. $2.
$2.
Huh?
A nominal fee. Because the value of the business with all its potential liabilities was arguably negative, but Nomura wanted the people and the footprint in Europe. They got a massive European investment bank for the price of a cup of coffee.
That is the ultimate humiliation.
It is. But the pain wasn't just for the highly paid bankers. We have to talk about the human cost for regular people, the mini bonds.
Right. This wasn't just about rich people losing money on the stock market. This had real-world consequences.
In places like Hong Kong and Singapore, Lehman had aggressively marketed these complex, structured products called mini bonds to retail investors. We're talking retirees, grandmothers, people who thought they were buying something safe.
They were sold as being like a savings account, but with a better interest rate?
Exactly. But they were linked to the credit of Lehman and other banks. When Lehman collapsed, these bonds became completely worthless overnight.
And there were massive protests in the streets of Hong Kong.
Tens of thousands of people lost their entire life savings. It was a brutal lesson in how interconnected the global financial system had become. A bad mortgage written in Nevada, packaged by a banker in New York, ended up destroying the retirement of a shopkeeper in Kowloon.
And the legal mess, the liquidation, it dragged on for more than a decade.
The final distribution of assets from the Lehman brokerage unit didn't officially conclude until September of 2022. It took 14 years to unwind the whole thing.
And here's the most ironic part of the entire story. After all that, how much money did the Lehman estate eventually pay back to its creditors?
This is the kicker. They eventually paid out over $115 billion.
Wait a second. If they were able to pay out $115 billion, that means they had the assets. They weren't broke.
Exactly. And that is the core lesson of this entire deep dive. Lehman Brothers was not an empty shell like Enron was. Enron was a fraud from top to bottom. There was nothing there. Lehman had real assets. They owned buildings, they had loans, they owned stakes in companies. In the long run, they were probably solvent.
But they weren't liquid.
They died of a liquidity crisis. They couldn't turn those long-term assets into cash fast enough to pay the bills that were due on that Monday morning.
And even more than that, they died of a trust crisis.
Yes. That's the perfect way to put it. The entire modern financial system operates on confidence. It's a magic trick. We all agree that the digital number in our bank account is real money, so it is. But the moment the market decides, it doesn't trust you anymore.
The math stops mattering.
The math becomes irrelevant. It becomes a self-fulfilling prophecy, a run on the bank, but at a global institutional scale.
And culturally, Lehman's legacy is just. It's the ultimate bogeyman.
Oh, absolutely. They're the shorthand for Wall Street greed and collapse. They're the villains in The Big Short, margin call, too big to fail. There's a great gag in the movie Despicable Me where the villain goes to the Bank of Evil, and on the sign it says, formerly Lehman Brothers.
You know you've made it into the Hall of Infamy when you're a visual gag in a kid's movie.
It's the new gold standard for financial collapse.
So, as we wrap up this deep dive, I want to leave our listeners with one final provocative thought. It's easy to look back at 2008 and say, those bankers were so reckless with their 30-to-1 leverage. And they were. But the fundamental problem hasn't really gone away.
The risk has just moved. The leverage isn't quite as high inside the big banks themselves, maybe, but it's migrated to other parts of the system, to private credit funds, to the shadow banking world, to government balance sheets.
The question Lehman's collapse forces us to ask is this. In a system that runs almost entirely on faith, on the collective belief that the person on the other side of your trade is good for the money, what happens when that faith evaporates? Because when it happened to Lehman, 158 years of history and hundreds of billions of dollars just vanished in a weekend. And there's no reason it couldn't happen again.
And that is the thought that should keep all of us up at night. The incredible fragility of confidence.
Well, on that slightly terrifying note, we're going to wrap it up. We have linked the Valukas report and our other source materials in the show notes if you want to go even deeper into the abyss. Thank you for joining us on the deep dive.
Thank you.